Jack, Melody. I love these combo shows. And Melody's been on a bunch. Jack, you've been on a few times. And first of all, I want to thank you both for thinking about me because there's so much happening right now. And this is what Jack and I, Melody, you hadn't jumped on yet, but Jack and I were talking about offline a little bit was, you know, the border that's quieted down and other things have quieted down. But, what you two are covering, I think it's some of the most fascinating stuff out there right now. And I don't know about you, but I feel like it's not getting enough attention. Whoever wants to opine on that first.
I think it's going to get attention whether people want it to or not. Because, with these two stories that Melody and I have been kind of independently covering are slowly gaining mainstream attention. And actually, both of them, Melody even mentioned to me over the phone the other day, both of these stories have been like on CNBC this week. What's kind of going on with this AI bubble that I've been tracking that appears to be, at the very least, it's no longer inflating, even though they're blowing harder and harder into it, which typically precedes the pop. That has all the hallmarks of 2001, the dot-com bubble. And what Melody has been covering with the FHA loan fraud, which just blows my mind how many people are not paying their mortgages for how long and getting away with it, that has echoes of the 2008 housing crash. I think correction's an understatement there. And it looks like both of these events may be coming to a head simultaneously. And so, at risk of getting a little too crash bro-y here, it looks like we're on course for a dot-com bubble and a housing crash at the same time, simultaneously. And we've just never seen anything like that.
So let's start off with the dot-com potential crash, and then we'll shift over to the FHA, if you don't mind, Jack.
Sure. So what happened last week or earlier this week, you may know that the CoreWeave IPO finally happened. CoreWeave is known as a hyperscaler. They build out data centers. They buy these expensive NVIDIA GPUs, and then they rent them out by the hour to the AI startups. And I have been very critical of this company for better part of a year and a half now. I first caught wind of this company in August of 2023 when I noticed NVIDIA had posted a fantastic earnings report. They had beat their data center revenue numbers by $2.3 billion. This was middle of August 2023. And shortly after that story broke, there was another story about this company I had never heard of, CoreWeave, and how they had just borrowed $2.3 billion to buy NVIDIA chips, and that those NVIDIA chips that they were buying was the collateral for that debt. And right away, that just jumped out at me like, okay, here's the number exactly matches the revenue beat. So that's highly suspicious. And at the same time, circuit cards, computer equipment being used as collateral for billions of dollars of debt. I mean, anybody who's worked with this kind of equipment knows it does not hold its value. The obsolescence cycle, the depreciation is massive. So to use it for collateral for billions in debt just struck me as grotesquely reckless. And so I started looking into this CoreWeave company in August of 2023, and within 5 minutes, I could tell that these guys were shady as all get out. I mean, I go to the CoreWeave website, I look up their founders, their CEOs, I go to their LinkedIn pages, and within 5 minutes, I'm staring at the network of shell companies in the Cayman Islands that they used to run carbon credits through, and the International Consortium of Investigative Journalists website, as part of the Paradise Papers leak. And that's not an outright illegal thing to do, to trade carbon credits through shell companies. Maybe there's a legal explanation for it, but it is something that criminals do all the time, right? And there's all these warnings from Interpol about how financial criminals could engage in money laundering or tax avoidance using this exact method that the CoreWeave founders used to use when they ran this company called NatSource. And then I found out that they were crypto miners. That's another sector that overlaps with a lot of financial crimes, not by itself indicative of financial crimes. But just here within 5 minutes of searching, I've got a suspicious coincidence of a revenue beat with NVIDIA. I've got collateral that makes no sense. I've got carbon credits through shell companies, and I've got crypto mining. And I'm saying these guys are so sketchy, we need to ask questions about this. So I started doing research about it, especially because the AI bubble hadn't really inflated yet at this point. And I did a couple of videos about my suspicions. I didn't have any proof of outright fraud. I still don't. There's still no outright proof of crimes happening. But man, there's a lot of smoke. And those videos went viral-ish. You know, they got a few million views on X. They didn't do quite so well on YouTube. But the response from the mainstream was to call me a conspiracy theorist and a Twitter rando. And this analyst from Bernstein writes this debunking article that didn't mention Magnetar, didn't mention crypto mining, didn't mention carbon credits or anything. Was loaded up with personal attacks against me and some of the other researchers that were looking into this, didn't mention any of us by names, and tells the world, don't look. And now here we are a year and a half and some $10 trillion in bubble market cap later, and people finally got to look behind the curtain when CoreWeave filed their S1 filing for the IPO, and it's everything I warned about. All laid bare. Everybody can see it. Red flags galore. And now everybody is saying the exact same things I said 18 months ago when everybody said I was a conspiracy theorist and a lunatic.
This episode is brought to you by McIlvaney Financial Group. Their advisors bring a depth of knowledge and experience that allow them to serve their clientele with care, ensuring their financial needs are met now and in the future. Personally, I'm not saying cash is worthless, but you can see what's happening. It's worth less every year. Gold is the opposite. Click on the promo link in the show notes or go to www.mcilvaney.com/coffeeandamike. Why do the IPO now then, knowing that this is going to, put all this out there?
Why now is a great question. The time they should have done it was about 6 months ago. If they had done this last fall, and that seems to be the consensus, I've even heard some of the guys from CNBC saying this, the time to IPO this thing was last year when everything was still making new highs. But this time last year, the CoreWeave founders were too busy cashing out in a secondary. The three founders personally sold $500 million worth of stock to Magnetar and Blackstone and other firms when they should have been IPOing the company. That was their window. So now the IPO had an element of desperation to it. It was like, we got to get this thing out the door before everybody realizes what it is. And there was a lot of scrambling at the last minute. Things like they cut the size of the IPO and the valuation twice in a week before it went public. I got the numbers here. They were initially going to raise $4 billion at a $35 billion valuation. 24 hours before they actually went public, they cut it to raising $1.5 billion at a $23 billion valuation. So they had to reduce the size of it because there wasn't enough demand. And not only that, the day before the IPO, NVIDIA had to come out and say, we're going to commit $250 million to anchor the IPO at $40, which means no matter how low the shares went, NVIDIA would spend up to $250 million to buy those shares back up to $40. So right there is what I've been saying all along, that this is a round-tripping scheme, this circular movement of money. It's all been about inflating stock values for Silicon Valley and Wall Street. And now you've got NVIDIA, who is CoreWeave's sole supplier pretty much. They buy other stuff, but mostly NVIDIA buys from CoreWeave buys from NVIDIA. So NVIDIA takes a stake in CoreWeave. They own about 6% of the company pre-IPO. CoreWeave takes that money, hands it right back to NVIDIA to buy the chips. All right. Then we learned in the S1 filing that NVIDIA is also CoreWeave's second largest customer. So NVIDIA is renting the chips right back from CoreWeave. And lastly, NVIDIA has to anchor the CoreWeave IPO. So, to talk about round tripping, or DA Davidson is out with a report drawing comparisons to Enron and their special purpose entities, saying it really looks like CoreWeave was created to inflate NVIDIA's stock price, which is kind of what I was suggesting all along. NVIDIA gives money to CoreWeave. CoreWeave gives it back to NVIDIA. NVIDIA gives it right back to CoreWeave. It's the same money going back and forth. The only underlying businesses here, these AI startups like OpenAI, they all lose money. So there's no profitable business underlying this whole bubble that has now been allowed to balloon into more than $10 trillion.
How does it, knowing that you've been called, been attacked since you've been, reporting on this, how does it make you feel that you're seeing, you're turning out to be right about all this?
Well, we did have a long conversation about profanity use before we went live here, Mike. And I used to work on a commercial fishing boat in another life. So maybe I'll temper some of that. But, there was some bleeps and some expletives. A lot of disbelief. Like when I saw what they were really doing, especially with that Bernstein article, how carefully they worded it to not give the viewer any idea how to search what was being said about CoreWeave, while the message is ignore them, they're conspiracy nuts, they're Twitter randos. I was really blown away by how overtly sleazy that was, just incredibly sleazy. And now a lot of the people who were chiming on that and talking smack about that are now saying, oh, I called it all along. I could have told you this was going to happen. No, you were one of the people piling on when the number was going up. And, you know, it kind of sucks to be the guy at the party who's saying, turn the music down. The cops are going to come and it's going to blow up the party for everybody. And then we're all got to go home. And some of us might be going home in handcuffs. So, you know, like, hey, turn the music down so we can keep partying. Nobody wants to be that guy. I was that guy for a year and a half. And then, of course, after the cops show up and they ruin the party, it's not like that guy can go say, I told you so, and gloat over it, because the party's over. He's going to get even more beer thrown at him. So, you know, it hasn't been a real enviable position. It feels good to be vindicated, or at least partially. I don't think I've been vindicated yet. But the indication is that's coming now. And you've got what I was saying 18 months ago is now becoming more mainstream. You got guys like Dan Nathan saying you'd have to have your head examined to be buying this thing now after reading what's in the S1. So, you know, it's bittersweet, and it pardon my French, but it just really sucks that it got this bad, because the people who are going to take the heat, the CoreWeave founders, they cashed out $500 million personally, set for life times 10. Doesn't matter what happens now to the company. They're already cashed out. Companies like Magnetar Capital, they just unloaded into the IPO. Plus, they have protections that they get their money back no matter what. So they're made. You know, the people who have done this have already done it. They've already made their money. And now it's going to be people whose pension funds, people whose mutual funds and IRAs are invested in, if not this company directly, companies that have had their valuations overinflated because of this company. It's going to hurt average middle-class people and their nest eggs and their retirements the worst. And I was trying to warn people about that $10 trillion ago, and now I think it's too late. I think that damage is already done. So,
Jack, do you think that they did it to get that liquidity, right? Like I mean, there's no skin off their nose, right? By IPOing, they were able to get the bump and go. I mean, do you think that's why they pulled the trigger?
Yeah, I mean, it was basically, let's dump the bags on retail was the whole point of that. You know, they at some point when you're inflating this company, you got to cash out and sell, and that's what the IPO market is for. And they started to realize it. Like, there was a couple of notes from TD Cowen in February and March of this year. One of the other things we learned about CoreWeave, their largest customer was Microsoft. 62% of their 2024 revenue was from Microsoft alone. And in February, Microsoft, or TD Cowen, comes out with a note that says Microsoft has scaled back a few hundred megawatts of data center projects. And everybody was like, oh, this is fake news. It's not real. Microsoft kind of denied it, kind of didn't. They issued a very carefully worded statement that didn't outright refute it, even though Jim Cramer and the other clowns on TV were saying, oh, this is fake story. And then in March, just 3 or 4 days before the CoreWeave IPO, TD Cowen came out with another note that said it's not a few hundred megawatts anymore. Now it's 2 gigawatts. You know, there's some guy in my head saying 1.21 gigawatts right now. Every time I say that number, I can't help but think it. And so those 2 gigawatts included data center projects that had been canceled in the last month. So now you've got CoreWeave's biggest customer is shrinking their spend on CoreWeave. So this was like a death sentence for CoreWeave's IPO. And that's when the panic started. That's when they started to cut it back, the size, the valuation. That's when NVIDIA had to come in and anchor it, because it was pretty clear that they missed the bus. They waited too long to get this IPO out. Did I answer the question? I'm sorry, I went off on a tangent there.
You answered. No, it was awesome.
So
go ahead, Mike.
No, you're fine. Revising the number, they revised the number down then for that IPO. Did they hit that target?
Today it's over that target. It's up pretty big today. It's trading like $44 right now as of the making of this. It actually opened at about 39. It traded as low as 35 yesterday. So they closed on IPO day at 40.00. Like exactly $40, as if NVIDIA said, all right, turn on the buy algorithm, buy it up to $40 like we promised, not a penny higher. And that's where they closed at. Then on their first full day of trading, they sold off 7 or 8%. They're up pretty big today. They're still way below the initial valuation they were seeking with their IPO. They were trying to get between $49 and $55 a share. They're trading around 44 right now.
So what happens now, or what in the short term, next 30 days?
Next 30 days, I wouldn't expect any big fireworks unless like we get another story from Microsoft. There was a story in The Information over the weekend, which has been a fantastic website tracking the AI bubble, that said companies like Palo Alto Networks, Thomson Reuters, and Intuit are cutting their AI spending on compute by 95% by using DeepSeek instead of some of the traditional large language models. And if companies are cutting their compute spend by 95%, then forget it. CoreWeave is toast. This company's earnings are going to fall off at a cliff. Now, unless stories like that keep coming out, which they have been coming out rather rapid fire for the last 2 months or so, that would drag CoreWeave stock down. The big thing I think people don't see coming with CoreWeave is in October of this year, interest payments kick in on one of their big debt facilities. CoreWeave has 2 big loans out there, 2 big lines of credit. That $2.3 billion loan that I talked about, which is what first got me on their scent, and then a bigger $7.5 billion loan facility that they took out last year. Now, they're only paying interest on the smaller one right now. The bigger one, the interest payments on that kicks in October. And some quick math on the numbers here. Where's CoreWeave's actual performance? CoreWeave had $1.9 billion in revenue last year, but they actually lost $900 million. So they lost $900 million without this added interest expense that's going to kick in October. And it's going to be a big one. It's going to be several $100 million a year more. And on top of that, they're already losing money renting out their GPUs. The price of GPU rental is in decline. It was over $5 for an hour of an H100 GPU last year. Now it's about $2. It's actually under $2 in a lot of places. So you've got what they can rent their equipment out for is dropping rapidly. You've got their interest payments, which is already monumental, are about to balloon out of control. And on top of that, there's this other big elephant in the room known as depreciation that's out there. And CoreWeave is claiming in their financials that these H100 GPUs have a useful life of 6 years. I don't know if you've ever used a 6-year-old computer. It ain't fun. So the depreciation right now, they're averaging out the cost of these things over 6 years. I don't know what the actual number is going to be. My guess is closer to 3 or 4. You've got Jensen Huang is at GTC last week saying as soon as Blackwell comes out, you won't be able to give hoppers away. Well, CoreWeave just spent $8 billion on hoppers in the last 2 years, and they're claiming they're going to be good to rent for the next 6 years. And the CEO who sold them to him is saying you can't give them away. And he tried to walk that back the next day. The company spokespeople were like, oh, that was just a joke. Don't worry. I'm not so sure that was really a joke. So the financials of this company don't improve. They get worse. They get worse fast.
How much of an impact DeepSeek being put out to the public did it have in unveiling all this?
I think DeepSeek was kind of like the start of it. When DeepSeek hit, that was the moment the narrative went from demand is insane, kind of like Crazy Eddie's prices. No similarities there. It went from the demand is insane to, oh crap, let's dust off talking points about Jevons paradox that somehow GPUs getting 95% less needed is going to make the demand for those increase. At least that's how they tried to spin it. They said and there is this economic theory about how when cars become more fuel efficient, gas consumption goes up because people drive more. Okay, yeah, we're talking about a couple of pennies on a gallon of gas, not a 95% reduction in demand for something that never actually had any real demand to begin with. It was all created by smoke and mirrors accounting. So yeah, DeepSeek, I think, started this. That was when the narrative first started to shift. And then it was a few weeks later that we've got the first indications from Microsoft that they were going to scale back their investments in data centers. And I've been using this phrase, the great game of CapEx chicken, on my channel a lot. All of the big tech companies right now are in this contest to see who can burn the most money on AI. Because when they say, I'm burning 60 billion this year, I'm burning 80 billion this year, all their stocks go up together because it means the bubble is going to keep going. They're going to keep the circular accounting going. And so it's like a game of chicken, two cars steaming at each other, right? If nobody blinks, we're all going to die. But whoever blinks first loses. It's a twisted game, but that's what big tech is doing right now, lighting their own investors, their own shareholders' money on fire in order to keep the stock price inflated. The second it stops, this bubble bursts and these valuations go back to where they were in 2022, which is a hell of a lot lower than they are now.
And the impact this is going to have on regular people, like you mentioned earlier, in regards to 401ks, pensions, and what they're going to get crushed.
Absolutely. Like, even people don't realize it. Most people set it and forget it. They have their guy. Don't worry, he's a nice guy. He comes to the dinner once a year. What he's probably doing is putting most of your nest egg, your 401k and your IRA, into index funds, mutual funds. And I don't care what they call it, the growth fund, the target date retirement fund, your brother and sister's fund, whatever it is, it's 50% to 90% made up of these Mag 7 names. Almost every one of these passive funds that's out there, it's Apple, Microsoft, Amazon, Google, Nvidia, right? And a few others like Tesla and Facebook. And all these names are going to go down in unison together when this happens because they've all been inflated by this AI bubble.
What also with DeepSeek, didn't it, when that was released, didn't that show how, and I'm asking this as a question, how NVIDIA, like these companies were so overly inflated because they just put out DeepSeek to people at no cost?
So that is one thing. You had the big reduction in compute requirements that kind of showed, hey, this bubble's a little bit fake, smoke and mirrors, if you will, or maybe the demand won't be insane forever, as if the narrative has been that it's going to stay this way forever. It clearly won't. We saw this in the dot-com bubble with fiber optic cables. But another thing that the DeepSeek thing laid bare that I haven't talked about was the export controls violations, selling these advanced chips illegally into China. And it was in about 2022, the Biden administration put some very strict controls on these Hopper GPUs. They could no longer be sold to Chinese companies. And right as that happened, you saw sales to China stop, and all the other server manufacturers.
Jack, you froze up for a second. Say it again. So is China, the Biden administration?
Okay. Can you edit this, by the way? Or
no, you're good. No, it was only a split second, so it was fine.
All right. So in 2022, the Biden administration puts these export controls on the GPUs. You can't sell them to China anymore. Right as that happens, all of a sudden you see NVIDIA's growth in China levels off. It stops getting bigger. And all of a sudden they start seeing exponential growth in sales to Singapore. Singapore is now NVIDIA's second biggest market. Well, Singapore is a city. It's not a whole country. Obviously, they're not selling all of these GPUs to Singapore. And NVIDIA's cover story is, oh, Singapore is just a billing location. They're actually being shipped somewhere else. And they're claiming it's the US, but we can actually see from the Taiwan Semiconductor export data that these things are being billed to Singapore and shipped to Malaysia, where they disappear. And from Malaysia, they're clearly being shipped onto China. And after DeepSeek came out, this is something that there's a guy on X named Kakashi who's been all over this since it started. After DeepSeek came out, this went from this thing that we deny is even happening to everybody in Silicon Valley started acting like it was common knowledge. Oh, we know DeepSeek has thousands of these NVIDIA GPUs. Well, wait a minute. Where did they get them from? If it's illegal to sell them to China, how did DeepSeek get them? And then doesn't that mean then that a lot of this insane demand that we've been hearing about, not only is it fake, created by smoke and mirrors accounting here in the States, but it's also illegal sales to China that at any minute then the windbreakers could bust into NVIDIA's office and start hauling away filing cabinets and arrest these people for freaking treason. These are American companies with American CEOs of Taiwanese descent, I might add. I mean, the insanity of what they're doing in the military applications of potentially of AI. And so DeepSeek laid bare the illegal sales to China as well. And I've done videos on my channel showing, social media posts of guys in China with warehouses full of Supermicro servers, full of NVIDIA GPUs. Chinese guys saying, here's my H100 GPU that's illegal for me to buy. Literally, this guy is doing this in China, and yet here I have it. It's pretty clear that they've been lying. They've been selling these things to China. They have plausible deniability. They're playing stupid, saying, no, it's only going to Singapore, and we have no idea. We insist our customers follow the law. When it comes to export control violations, I don't think they're going to be so flexible about that, especially not considering the potential geopolitical consequences of that.
Why did the Biden administration, why did they put that into place where you couldn't sell this to China?
Oh, it was all about military controls. I mean, they had finally, right? I mean, we're teaching drones to tell the difference between a tank and a truck from an aerial overhead photographs. We're teaching missiles how to evade interceptors, and the Chinese are doing the same thing. They're teaching their missiles to more effectively target our aircraft carriers in the event of a war over Taiwan. So there's absolutely military applications for this stuff, and banning those chips into China was all about the U.S. technological edge if it ever came down to a conflict in the South China Sea.
Before I forget, what's the website you use to track AI?
By track AI, what do you mean?
You mentioned
Inform, you said.
The information. Yeah, the information. Yeah. It's a relatively new website. I only caught wind of them a few months ago. And the fact that Jim Cramer keeps referring to them as a rag that lies tells me these guys are right over the target. And the information is one of the websites that first started breaking stories like NVIDIA's next generation Blackwell chips were having overheating problems. Everybody in the press said that was fake news. It ended up being true. The Microsoft scaling back their AI investments. Everybody said fake news. It ended up being true. And the DeepSeek story. So the information has been fantastic. And just today, Cramer is saying, "Oh, they should sue this rag for talking about talking about how Palo Alto is scaling back their AI investments because of DeepSeek." So, when you see these guys railing against this website that has been vindicated several times over now, that tells me that's probably someone you want to pay attention to.
So it's called The Information?
The Information is the name of the website, yes.
Theinformation.com.
Yep.
You have to spell things out for people these days, Jack. So DeepSeek has really been a disruptor in all this.
Absolutely. Yeah.
It really showed, just with some very simple engineering concepts that we had the amount of resources we'd spent on this was real stupid. And it's funny because I come from, although I've been in mortgage for the last 20 something years, I did fintech, in the past 5 years, training language models, things like that, because we were theoretically adopting AI, theoretically doing one of the big things in mortgage is OCR, or optical character recognition. But ultimately what would happen is you would be training the models to recognize these documents, and the client would want the efficiency. And what would end up happening is you'd use a room full of Indians. And I don't mean that, in a derogatory way, but to name and classify the documents, because the technology just wasn't there. You spent so much time trying to train, and then it would get off track and you'd have to retrain again. It was at a point where, humans were just doing it faster and you could pay them a lot less in India. So, I come from the tech world where we were trying to, use these things in application, and it just was not working out. And so I had a lot of suspicion about what was happening. But the other thing that when I was doing fintech, I learned is that Western developers, and I'm going to get some hate for this because I said it in our last show, Michael, Western developers had really kind of stopped being creative. They were too busy playing foosball or, going to get their matcha latte in the break room. I just remember trying to work with them. It's 3:30. I have to quit work. I'd be on calls, working with head developers, like for a big bank like PNC. And they would say, "Well, I don't want to try to solution on this call." And that was their way of, that's just too much thinking for me. And so what we would ultimately have to do is use offshore developers who, at the end of the day, they would do what you told them to do, but they themselves weren't either creative. And so you were just kind of like a hamster on a wheel. And so I think what DeepSeek really did was challenge, Western development and say, "Sorry, guys, you need to be a little more creative. You need to be a little more nimble." And regardless how much it was, how much was paid for it, who paid for it, it didn't matter, because those engineering concepts disrupted this whole space, in my opinion. I have to say that, right, Mike?
Yeah. People,
Yep.
I say it all the time now. Personal life on here, you always, or you do I am why, which I just figured out what that meant, by the way. Sorry, Jack.
The thing about DeepSeek, I think there was probably like a little bit of truth in every facet of that story. It did lay bare the GPU smuggling into China. I think there's no denying that, and everybody even stopped even trying to deny that once the DeepSeek story came out. I do think there's a little bit of intellectual property theft going on there, China and their 1,000 Talents program. I'm sure you've got a lot of Western trained engineers and a lot of stuff that probably walked out of OpenAI on a thumb drive and found its way into China. I think you had a lot of that going, and you did have some legit innovation that also happened at the same time on top of that. And the big thing now, you still need the GPUs to train the large language models, but the actual inferencing, the actual running of the large language models, once it's trained, you can create these, I think they call them distills. You can create these small scale chatbots that do one task really well. You can run them on a local machine with a simple gaming GPU without the need of a data center at all. And, that's really the big innovation here, is that you don't need a chatbot that can do everything. You need a chatbot that can do what your company wants it to do specifically.
Absolutely.
DeepSeek can create that scaled down model for you, run it on cheap equipment. And you don't need a CoreWeave for that, do you?
Nor do you need all the data centers we've built across the United States that are vacant that I've seen on my travels. I mean, there are so many of these things that will never be operational. And they're everywhere. I mean, they're everywhere.
So I want to switch over to Melody here in a second. But one more question for you, Jack, because you mentioned both the AI bubble and the real estate bubble. It's on track for a perfect storm. Let's just say the real estate bubble doesn't happen, just the AI. What kind of impact is that going to have as a standalone issue on regular Americans?
I mean, the first direct impact is going to be, you're going to see your nest eggs shrink substantially. The S&P 500, right? With passive buying, which is what you've had, people take their paycheck and they put it into the S&P 500 index and it passively buys the whole market. But a lot of these funds are weighted, which means a lot of it is targeted buying of NVIDIA, of Apple, of Amazon. You're going to see that in reverse, and it's going to be rather swift and rather sudden. So I do think you're looking at a lot of people are going to be afraid to look at their IRAs and their 401ks for a while. I also think you're going to see things like electricity might actually get cheaper, because a lot of electricity right now is being bid up. We're seeing power prices rise to power these data centers. Actually, 3 Mile Island, a nuclear plant owned by the company I used to work for, they're actually starting it back up to try to save that plant just to power a Microsoft data center. I wonder how safe is that deal now that Microsoft is pulling back from some of their data center investments. I would love to see that power plant come back online. I know a lot of people that work there, and I hope it goes well for them. But I think you're going to see ripple effects right away in the utilities market.
And Michael, if I could have a crack at that, and this is why the thing is, when in the COVID boom during origination, I had this I was working at a fintech company, but I had a weird little group of loan processors that every once in a while I'd have to go, problem solve something that was going on with them. And the amount of people that had one stock in their portfolio, the amount of people that were Tesla only was wild. And we've seen what's happened with Tesla. Now, I guarantee you that NVIDIA took the place of Tesla for those bros are kind of in terms of trying to get rich quick around stock. And so this is why I can tell you that if that AI bubble bursts, then housing is going to be in a lot of trouble, because you have people who are piled into the stock market. The funniest thing I'm hearing about housing right now is sell your house and go invest in Bitcoin, because, housing is not sexy anymore. Being a landlord is not sexy anymore, because no one is cash flowing, and those, insurance costs, if they can get it, those increased property taxes, the cost to carry to replace things, and the fact that we've built so much multifamily, so much housing, that you don't have the demand out there because of our demographics, as well as it's completely unaffordable. So if something happens with AI, it will absolutely impact housing.
What were your thoughts? I saw you write that in your Substack. What was the first thing that came to your mind when you saw somebody say, sell your house and buy Bitcoin?
Michael, I think I do a lot of management of my thoughts these days because it is just so crazy to me, right? And I think I didn't have a reaction, to be honest with you. I mean, I just kind of went, okay. I mean, here we are. This is where we are. But deep down, how I feel is, oh my God, it's funny. I did a lot of writing about FTX when I first joined Twitter because I was just absolutely fascinated by, this whole thing. And back then I was really trying to chase down the Bitcoin crypto real estate connection because we're going to find one and it's going to be big. I mean, we had a little bank blow up that was theoretically a crypto bank and real estate, but I think it's bigger than we actually know. That there was a lot of probably speculation and gambling and money laundering through buying of properties. But I was just fascinated because I knew those two things were going to cross paths. So to answer your question, I think I wasn't surprised. But what's so funny to me, and I don't know if you guys feel the same way, is that I'm finding a lot of the ways, the things that I was thinking about, talking about in 2022, I'm starting to talk about again. And 2023, because, that mania, the fact that it's just kind of come back on steroids is just so wild to watch. I don't know if you feel the same way, Jack or Michael.
Well, I mean, the AI bubble started in November 30th of 2022. That's when ChatGPT was released. And if you look at what all these stocks we've been talking about have been doing through all of 2022, they were in free fall. Silicon Valley needed the shiny new thing. Yes. Crypto had burst. Internet of Things fizzled out. The metaverse. Let's not even start on the metaverse. They're still spending money on that. Oh my God.
But I forgot about the metaverse.
Oh yeah. Any day now, that metaverse real estate investment is going to start paying dividends.
Right.
Any day now. So Silicon Valley really needed the shiny new thing, and it was ChatGPT, and ChatGPT was neat. But what it really looks like is Silicon Valley got into bed with some of the worst examples of Wall Street to take that shiny new thing and turn it into the big new bubble. And that's why I say I think we're going back to 2022 valuations, because that's where we left off. That was the last time we had anything resembling price discovery in stocks, and stocks were in free fall at that point. And watch how fast they pivot to quantum computing and humanoid robots and all this other crap. Might as well invent a time machine. I mean, that's what's coming next. They need another shiny new thing just as soon as AI fizzles out.
That is so true. A word you used, I want to ask you a question, Jack. So who holds those two loans that CoreWeave has? Do you know?
It's a consortium. I believe Blackstone is the biggest holder of it. Blackstone, Magnetar, Coatue, several other ones. I mean, they borrowed about $8 billion out of a potential, I think, $12 billion in total loan facilities. And then you got to wonder, I think I know where you're going, the counterparty risk. Who does CoreWeave owe money to? And then what happens if they don't get paid? Who do they owe money to? Yeah, that's now you're getting into second, third order knock-on effects. Who knows where that goes?
Right. And I'm curious about the bank that probably did the underwriting for the syndication. That's something I want to go look into. But a word you use that I think is really important and would actually transition us, Mike, to the FHA story is circular. What people really don't understand about what mortgage has become post GFC. And in reality, it was this already. It's just now we've got the government doing it. When you are originating a mortgage, you are literally taking $1 around the system and just recirculating it. Because essentially what happens is your non-bank, who does not have deposits, and they do the majority of lending, right? They make a loan. They use liquidity that they have borrowed from a bank. They originate that loan. They turn around and sell it to Fannie, Freddie, Ginnie, whomever. They get that cash back They go back into the system to do that again. But what happens is then from the agencies, they package all those securities up. They sell them off. The investors give the agencies money. And then the agencies might do something like a credit risk a risk transfer securitization, which is going to package up the risk even more and sell it off to pension funds and other places like that. And then essentially that money goes back into the system to come back around in the origination process. And so it is just one big circle of dollars like moving around the system. And this game, and so this is, I always get her name wrong, Michael, but it's Catherine Fitz Austin or
Catherine Austin Fitz.
Why? I can't do it. I don't know. But anyway, she talked about when she was head of HUD, right? That they would use FHA and these securitizations for liquidity. Like they would actually securitize homes that didn't exist, or they would be homes that were sitting vacant and pretend like a mortgage had been originated. Because very similarly to the story that Jack is telling you, you can hide a lot in these securitizations. I mean, nobody really, it's not like somebody goes out and they say, okay, give me your 100 homes. We're going to put this in the securitization. Nobody's going out to those properties. They're not doing anything like that, like checking to make sure that property is inhabited or whatever. And so this is just a big Ponzi scheme. It's just people putting money in. And can you make a couple of dollars here and there? I don't think so anymore. I got to be honest with you. I mean, and this is what I think Rocket and Mr. Cooper have figured out, by the way, who are both big players in FHA. This looks like some genius move. Guys, it's more than likely they both understand what's about to happen, because what they're facing right now in the face of lower origination is just expense hell. And these FHA programs have, that really got launched. So we've always had loss mitigation. During the GFC, it was very aggressive, but you still underwrote the loans. The borrower would still have to submit their financials. And so they had some skin in the game, and you could get denied. I mean, they could say, listen, there's no way you're going to pay this back. We're not going to give you a 40-year modification because you cannot afford it. Well, when COVID hit, what happened is instead of underwriting the loans, instead of you having to contact your servicer, because that was a big part of it, you have to fill out a complete application. There's all kinds of CFPB rules around that. Essentially what they said, well, we don't want to dissuade the borrower from applying for a loan mod. So we're just going to send it to them in the mail without any documentation and outright just offer it to them. So this is kind of what was going on before 2024. And the partial claim has always been around, which is, I think always, as long as I know. But it's basically where you can there's this pool of money that's paid for by the insurance fund. And if you are an FHA borrower, then you are paying into that insurance fund every month. But what they'll do is if you get behind, the way it works today is they'll take all of those payments and put it at the back of the loan to be satisfied at full payoff or when you sell the home. And you can do that for up to 30% of that unpaid principal balance, which in the case of a lower balance loan, that's not that big of a deal. In the case of a higher balance loan, which we're seeing so many of those now, it's a huge deal. And so what happened last year is they basically said, listen, we're going to do this payment supplement where the servicers didn't have to buy the loans out of the pool because this was a huge liquidity drain. I mean, there were servicers that almost went under in COVID. It was very quietly kind of squashed down. But this is why you had Yellen always talking about her fear over the non-banks and the Financial Stability Council, whatever that thing is called, because they almost went bye-bye completely. Because what happens for the servicers is they have to buy the loans out of the pool to modify them, which is a huge liquidity burn. Think about, hey, today you've got like $6 million in buyouts you got to do. And that's only a handful of loans, right? Well, they don't have deposits. They're using a liquidity facility to do all this. And so they almost, when they weren't getting, sorry, let me be clear. What happens is you have to pay those trusts no matter what. And so you have to advance that cash to Fannie Freddie. Jenny, that's the deal. So the investors will get paid, but even when the servicers are not getting paid. And so they came up with this new thing during, and I call it, it was election year politicking, where essentially you didn't have to buy it out and you could just keep doing these partial claims over and over, taking those delinquent payments, bundling them up in a non-interest bearing lien, and putting it at the back of the loan. So this is really what has kept. So already FHA. So it's so funny, Jack, that you said August of 23, because I remember in June of 23 on my little story, and this is how, these things are very similar in nature, even though they seem different, right? But in June of 23, we saw the first, what I would call the death cross in mortgage. And what does that mean? And I guarantee you, Mike, if you go back to one of our shows, we were talking about it. Essentially, that means when you go 30 days delinquent, you know that your credit is going to get hit significantly. And in this country, we are obsessed with our credit scores. And so in June of 23, when we had already had elevated FHA delinquency, similar to if you go back to the GFC, delinquency was elevated in like 2005, et cetera. And so they're always early. They're always earlier because it's the borrowers that are most vulnerable. And so I remember Danielle DiMartino Booth calling me. I was in Florida. And she's like, you have to pin that tweet, because I had said, FHA we've had borrowers make the death cross. Like, it's getting serious now, because it wasn't just kind of like this delinquency that had been around. It was a lot of new delinquency. And she's like, you have to pin that tweet. And so that's why I remember it so vividly. But that is when we really started to see the smoke. And like Jack, I was out there screaming to everyone. I said, listen, we're going to have loss mitigation. We're going to arrest it. But this should be telling you where the consumer is, especially, one cohort of the consumer. And like Jack, I cannot even tell you the amount of hate, just kind of, everybody in my industry did their best at trying to, make me look like an idiot. In September of 23, the head housing analyst wanted to do a debate. These were people that when this all started, we were all very collegial. We did articles in the same series. And so I really kind of got separated, which is just fine with me. No issues there. But, they really kind of relegated me from core housing group. And no one was really talking to me from the industry. So again, it's a very similar experience that Jack had, where I was completely dismissed, and not just dismissed. There was an active campaign to shut me up. I got my email spammed. I got shadow banned. It was actually kind of crazy. There were crazy bots, and I was so new to all of this. And really silly. I didn't realize that most of them were bots, actually. And then I was just kind of falling for this ridiculousness. But just like the CoreWeave story this week on CNBC, and guess what? Mark Zandi's coming out talking about, so you guys aren't from within the industry, but this guy is just one big, he's always wrong. He has never been right in his entire career, yet everybody thinks like he is the housing, economic expert. And he's now talking about it. And it, like Jack, there is a sense of like satisfaction, but that's a very small part of it. More of it's just like anger, because you're just, what are you guys doing now? And they're putting it up on CNBC now. Oh, FHA is a red flag. Okay, thanks. 2 years later. So, and just all of this, just gospel singing that the economy was just fine. But clearly, especially our most vulnerable borrowers, were starting to struggle. Now, the other thing that FHA has been used for is speculation. And there is all kinds of owner occupancy fraud, which what happens is essentially you can go in and say, I want a loan. I'm going to live in it for a year. And then you get to make only a 3.5% down payment. So you don't have a lot of skin in the game. What a lot of these Airbnb bros were doing is lying and saying they were going to live in the house for a year, and they're not. And so that was one type of fraud that was going on. Another type of fraud that we started to see, and I did a show with Mark McDonough, he's been in the industry for 30 years, is you had actual origination shops coaching people and saying, take out an FHA loan, you don't ever have to pay it. Because with these partial claims, you can just keep kind of taking those delinquent payments and putting it at the back of the loan. And if you're an investor, I mean, why would you not want to keep that capital deployed elsewhere, right? And so that's absolutely where. Go ahead, Jack.
I'm sorry to interrupt you, Melody, but that blows me away every time I hear it. And you got to realize, like, that's the what stage moment when you have guys selling courses online and pushing these workshops that say, go ahead and take this loan for a house you can't afford in order to buy it, lie, commit fraud about it being an investment prop or being your primary residence when it's really an investment property. And don't worry, you never have to pay the loan.
Right.
And this is widespread enough that guys are making a living teaching people how to do this. That it cannot go on forever. Sooner or later, that blows up in a spectacular fashion. And just something I want to chime in real quick. There has been a noticeable shift in the language out of Washington. They are no longer talking about making homes more affordable. They're starting to talk about bringing home prices down. That's a very subtle nuance, a very subtle change, but the difference is massive. It means no more taxpayer-funded bailouts, no more creative programs where you don't have to pay your loans. It could mean we are going to start taking the homes from these a-holes who aren't paying for them at somebody else's expense, and we're going to let them hit the market and bring the prices lower.
What I've been saying,
huge.
Yep.
Yeah, sorry. Go ahead,
well, no. I just want to. It's huge, Jack. It is such a change. And what I've been saying, I've been. It's funny. Out of the woodwork over the holidays, I had a lot of people contacted me with. They had properties in default. A lot of it had to do around something they inherited. Okay. And and you guys aren't going to believe this, but the origination dates on those loans were 2005, 2006. Okay. So they have been in extend and pretend for that long, guys. And I am not kidding around, because this is how forbidden foreclosures have been. Okay. So what the agencies would do is they would bundle up all of their non-performing loans and they would sell them off to hedge funds so that those headline delinquency statistics did not look as bad. And the hedge funds would be told, listen, you need to be very aggressive on the loan modification, or they could do things that you can't really do with the agencies right now, which are things we've done before, like cash for keys, and say, listen, you get out, I'll give you $20,000, because in a home price appreciation environment, you can still make money hand over fist. Guys, there are not many things in our sphere that can make as much money as a performing mortgage. I mean, it is a very, if you're one of these people that buy these notes, it's a very lucrative thing if they perform. It's when they don't that it's a problem. And so they would sell off these loans, make their delinquency stats look good, and give them off to hedge funds and say, you just make it right. And so quietly, these delinquent loans would be resolved, often though not in foreclosure, because everybody kind of knew that was forbidden. And so what I've been telling people, based on exactly what you said, Jack, is foreclosure is about to get sexy again. And people are about to start doing it, because there has been, just like there's some language that we can now use that we weren't able to use the last 4 years. This is a word that is going to lose that stigma. And I think the NBA really fell flat, and it is comical to see, because I got to tell you, the NBA was fighting all this back during the GFC. So to see this turnaround is hilarious. But they responded to the Wall Street Journal article about the fraud in this program. Well, not even the fraud in this program, just the way that it's been used. And they said, well, there would have been millions of foreclosures. Yeah, millions of foreclosures. A lot of them would have been for investors who lied on their application which would have meant your young family could have purchased a home because there would have been actual price discovery. And so I don't want any young working family to lose their home, but we have to have price discovery. We have to root out the systemic fraud in this program on both the origination side and the back end of this. It's in two different places. And by the way, what I'm hearing a lot and what a lot of people are saying is this is too hard to find. BS. I could find it in 5 minutes. Let me in your house and I will show you how to find it. And because that's my expertise on the mortgage side and my expertise on the tech side, it would be very easy. And so, I want people to hear that loud and clear too, because it's not that difficult to find this fraud. So yeah, anyway, go ahead,
What that
Jack.
really means, Melody, that thing you said, that there would have been millions of foreclosures if it weren't for this program. Another way to say that is houses are not really worth what people think they're worth now.
Amen, brother.
Right? If that many people aren't paying their bills, that means they can't afford homes at these prices. It means these houses, these prices that are shown right now are not real. And that Wall Street Journal article that you mentioned, there's one data point that just blew me away in that.
Oh yeah, I know which one.
Of 52,531 loans in 2024 that went 60 days delinquent in their first year, just bought the house, and in your first year, you missed 2 months of payments in a row. Out of 52,531 loans that fit that category, 9 went into foreclosure. Not 9,000, not 900, 9 out of 52,500. And this is people who bought their home and immediately didn't pay. Immediately. Right. It's just, it is institutionalized fraud.
That is.
And now you got politicians who are saying, we're done with this. We're going to stop doing it. Get ready.
I hope so, Jack. Like, I hope, because, something I went through in my Substack this week are the announcements that we've gotten that have sounded like they're being very aggressive and shutting down payment assistance programs, buy down programs, things like that. These are very small programs that they've shut down. 2023, about 15,000 loans for one of them. So not a big deal. They've shut down backing loans by FHA or USDA for non-permanent residents. Also, probably not a huge amount there. So for me to feel confident that they're serious, I think they have to. So right now there's a rule out there that says that it's a proposed rule that's supposed to go into effect next year, that you can't get one of these partial claims. You can only get one every 18 months. That would be huge. The other thing, the new guidance that's supposed to go into effect in 2026 would force you to do is do something called pay a trial. Now, this would preclude a lot of these investors getting away with this, meaning, so usually with a workout, you have to pay 3 months before you are finally approved, and they call it a trial modification. And so if they did that with the partial claims, they would have to put some skin in the game before they were officially approved for that workout. And so I think that the temperature has changed. The language is changing. That might be enough, but what I would love to see is for them to come in and shut this program down, to essentially just put the guardrails there. So it really is only the people that legitimately are working and they need some sort of short-term assistance. Because our buddy John Comiskey, the redefault rate on these is massive, meaning they just keep defaulting. And this is something I saw in the GFC so much of was you would give these folks this modification, and even if they qualified for it on paper, life just never works like it does on paper, right? Your car breaks down, your refrigerator breaks, whatever. These folks simply could not afford it. And so a lot of those modifications never helped anybody back during the GFC. I see it in client books right now. People who have been struggling for years, they will ultimately go to foreclosure. And that's stress, because I used to have to read all these hardship letters. that stress and what it does to families is the reason that I have been out here for 2 years talking about this, because I didn't want people to have to deal with this. And what I think, Jack, you and I both feel very frustrated about sometimes is that the people that need to hear us most refuse to listen. And so we aren't going to be able to help a lot of these retail investors, a lot of these folks that are going to get wiped out through the AI route, or because they believe their estimate, which, guys, I mean, Fannie Mae, I've said this on Mike's program several times. Fannie Mae themselves came out and they looked at over 7 million comparables, and they said 55% of them were inflated. They didn't have proper seller concessions listed. So you got to know that Zestimate is based on lies and it's not accurate. So if you are banking on it to save you, the only time that fake equity is going to be real is when you sell that home or when you can get a refinance. And right now, the Fed just told us they've had the highest mortgage refinance rejection rate they've seen since they started tracking in 2013. It's 41.8%. It was about 27% last year. That is massive. That means everybody that needed to refi for that cash, they're not able to access that equity. And sorry, I know that was a lot.
Well, no, I was just going to add to that. And they also know that ultimately they'll end up in foreclosure, the borrowers, but they're just delaying it, to just suck out a few more payments, buying a little more time?
No, they don't. It's not even like that. Like these entities, that's not, it's just, again, it's what that payments? Circular game. Yeah. It's just, yeah.
They're not making payments. It's, this other phrase I use on my channel all the time, Mike, I say the floor is price discovery. It's like Wall Street is playing this game of the floor is lava, right? We don't want to find out what things are really worth. That is the single biggest motivator in Wall Street right now in virtually every category of finance, is the avoidance of price discovery. Private equity firms are terrified of that CoreWeave IPO because they know they've got all these companies they invested in 2022 that they need to IPO, and they can't now because they're not worth what they paid for them. They don't want to book the losses. So they're creating these cockamamie funds where they're packaging the old investments into a new investment, selling that off to pension funds and retirement plans, using that money to pay the investors in their original fund and to create the illusion of profits. The same thing's happening in commercial real estate. The same thing is happening here with the FHA loans and the avoidance of foreclosures. The same thing's happening with these round tripping schemes to promote the revenues of these AI companies. The biggest driving force that makes people show up for work and do a good job in Wall Street is to avoid finding out what these things are really worth. You can only do that for so long. Rigged markets always fail eventually.
Well, and also, Melody, you were writing about this in your Substack. The cost, right? Mortgage or homeowners insurance, taxes. People can't afford these homes, and even the ones that own them can't afford with the upkeep. And that's where the
100%.
Airbnb market is.
Oh, it's toast. It's absolute toast. And I mean, going out to California was probably the biggest slap in the face that I've had in a really long time. But yeah, I think what so many people in my industry who believe the credit quality gospel singing somehow missed that they removed the debt to income threshold in 2021 because they were having too much fun originating all those loans. I think that they just absolutely do not understand the speculation, probably because people lied on their applications. Fannie and Freddie, I was so pleased to see that they put a cap on investment loans early on during the COVID boom. And I was like, okay, we learned our lesson. Okay, all right, this is smart. They removed it. I mean, because as the game started, as that money that needed to come in started disappearing, they stopped caring. And that's also when FHA went bonkers. And you can see it in the origination numbers. It was like, let's get everybody in the door that we possibly can. So, but the amount of speculation, the amount of vacancy across this country, okay? I live very close to a very old school the road to that school is about that I get off the highway is about 2 miles before I get off to go way deep into where I live. But that 2 miles, we've got 4 properties for sale and probably 10 that are vacant. And that is not an exaggeration. And these are perfectly fine homes that I believe, looking at characteristics of them, were bought as fix and flips, but people started walking away when they didn't have the money to rehab them, or they couldn't find somebody to live there, or they couldn't find somebody to sell it to. So what everyone in my industry is missing is how much speculation, because they have not gone and driven across the country. They believe all the crap that we heard from within, that things really changed. They really didn't. The players changed. You went from private actors to government actors, but really it's public-private actors. And so, they are under this delusion that it is your mom and pop, your regular family out there that took these loans out. And that is just not what happened.
So, I'd asked Jack, what would the impact be if just one of these things came to fruition? So I'm going to ask you on the FHA side, the trajectory it's heading on, what will that impact be just individually or for regular individuals?
Well, weirdly, if this is allowed to actually play out the way it needs to play out, this will actually mean lower home prices. And so once the gravy train, as my friend John calls it, once the gravy train comes into the station and is decommissioned, then these properties will make it onto the market. And they will do so at reduced prices. And it could actually mean that you're going to have folks out there who are going to be able to afford a home. Now, the problem with that is that they're going to be impacted, as Jack said, on the back end, through perhaps even pension funds or things because all of this stuff has been rehypothecated out there in the derivatives market. And it's treated like gold, Mike, because theoretically it has the implicit backing for Fannie and Freddie. It's the implicit backing of the government. For Ginnie, it is the explicit backing. But most of these originators don't understand the government never fully pays you back, and that haircut is quite significant. So it's going to impact. Unfortunately, I think once this explodes, there are going to be a lot of people that are going to be hurt. And so they obviously won't be able to take advantage, but ultimately it will result in lower home prices. Now,
the perfect storm here, if both these things occur simultaneously, what could the government do, the Fed or whatever, what have you, do to intervene? Or because people are going to be angry and demand some type of response. Is there anything that can be done?
Well, I have my answer, which nobody's going to want to hear. We should hope nothing is the answer. All right. There's a cancerous rot in the economy and it needs to be carved out. And yes, I understand what that means. That means people losing jobs, people losing homes. That means misery. What people need to understand, though, it's already been done to them. It just hasn't arrived yet. And if the government does take some action, it's going to look like the Fed creating a special purpose vehicle in order to buy all these troubled assets and put them on the Fed's balance sheet. But what does that do? All that does is artificially keep the value of these things higher when the prices want to come down. And what are they going to be buying them with? Printed money, which means you can expect more consumer inflation after that. So I hope they do nothing. I would love it if they did nothing. And, it's like, look, you're talking about easy money has created this problem. It's like a drug addict, and cold turkey hurts, right? And what's the easy solution is to just take more. And that's your Fed coming in and printing money to buy up these troubled assets. But that only makes things worse. That only prolongs the problem. So I hope the answer is nothing. I doubt it. These people are they just seem like incapable of doing nothing, but that would be the best possible outcome.
Yeah. And, I think I'm with Jack. I hope they do nothing. But one of the things that most people now realize the Fed buying mortgage-backed securities are why we are in this mess. And so I think if the Fed came out and said we're going to buy MBS again, there would be an uproar. We would have to be in a place of just absolute desperation. But here's the thing, they bought them back then in the GFC too. They were not able to recreate the same, kind of juice, because housing is considered the juice of the economy. It's anywhere from between 16 to 20%. And this is the tool that they have used over and over again to try to, spark the economy. They tried in 2010 with a big refi boom that fell flat on its face. It did not work. So, I think they may try to step in, but they won't be able to. One thing I do think might happen, the municipalities, we're finally starting to hear it, right? They're in a lot of trouble because they got that $320 billion through the CARES Act. And so they were living large and they thought that was just going to keep happening. And now they're all running out of money. Pasadena before the fires had to lay off 150 teachers because they had a huge budget deficit. So your municipalities are going to be in a lot of trouble at the same time that they're going to be the ones that need to take care of these vacant properties, these overbuilt properties as well. I mean, there are subdivisions in Texas that I've seen that are just one huge risk for some sort of migrant community to come in. Let's say somebody decides to bus the homeless from downtown Austin out to Manor to one of these empty communities just for fun. I mean, these are huge safety and soundness risks. And I think ultimately the municipalities are going to look to the government, the federal government, for help in managing these properties. So I foresee something like that happening. Who knows? They might try to put them in the sovereign wealth fund, right?
Put everything else in there, right? I mean, that's just going to get us out of this. Get old shoes. We'll put that in the sovereign wealth fund. Just put everything in there. I listened to Howard Lutnick on the All In podcast, and he was, I will say the guy, I wish he would have spoke at my sales meetings because he does get you amped up for what he's talking about. But it's like, it got to the point with the sovereign, just put everything in there. Put everything in my, basketball, everything. Just throw it all in there, and it'll totally get us out of everything.
It's wild.
More government involvement in the price of assets is not going to help anyone. Correction, it will help the people that currently own the assets.
Right.
That's who it'll help. The people who have been priced out of the ownership of these things, millennials, Gen Zers who are struggling with home ownership, that's who is hurt the most by all of this stuff, especially what Melody has been talking about. And I see this all the time. Like the popular thing is to like rag on millennials and say, oh, they're just lazy and they're avocado toast and all that. And yeah, I get some of that, but there are plenty of people working their hands to the bone, hardworking young kids,
Absolutely.
And home ownership is out of reach, right? Home prices finally stopped going up, but now the cost of everything else has gone up 30%. There's just no chance at home ownership without significantly lower home prices. And that's why I really hope they just do nothing. And I hope I'm not just overthinking it when I see that shift in the language from home affordability to bring home prices down. If that means what I think it means, that means you'll get your chance, millennials. It's coming. It's going to suck because along with that comes higher unemployment and 401ks and IRAs going bust. But at least you can afford a home.
Yeah, and
Jack, Jack, I hope, and I'm seeing that language change. I'm seeing it as well. And so I just hope they have the will to continue once we do hit real distress. That is my hope, that they will be able to have fortitude and stand strong as this thing starts to implode.
See if that survives the poll numbers. I share that hope, Melody, but you'll forgive my skepticism.
I have the same, Jack, the very same.
You guys are a lot better than I am. I can't even throw the word hope into all that because when panic starts to set in, the government's going to intervene. Like that's just, and when have I'm gonna get heat for this, but when do you ever see them doing? And I've said this for a while. What really needs to be done? I don't see anybody out there that's willing to do it. Maybe I'm wrong. At some point. I mean, I'm wrong more than I'm right, but they will panic and they will, whatever they think they can do to prop this thing up and kick the can down the road because nobody wants this to happen on their watch.
I'll be honest with you. Sorry, go ahead, Melly.
No, you go.
I said the same thing pre-election about Trump. I thought Trump was a money printer and an asset proper because he was in his first term. Big shift in his language in the second term, right? I mean, if you can see past all the orange man bad and everything else, which a lot of people can't get past that, but if you look at what he's actually saying, he no longer talks about his stock market like it's his report card, right? Now you hear things like, there's some pain in the stock market, but don't worry, it's going to be better in the long run. Big change, Trump 2.0 versus his first term. And that gives me at least a little bit of hope. Again, when the polls start shifting, because his polls will drop like a rock when this stuff starts happening. If price discovery ever does arrive, we'll see if it changes his language. I hope it doesn't. But he's already pleasantly surprised me by his willingness to be more realistic with the price of assets.
I was just going to end with this. I know we kind of run over time, but it's amazing to me in Phoenix how many apartments projects they continue to start here, like high-end apartments. Like, I don't know who's going to live in all these things. More and more and more.
It's nuts. And, I just shared on X Twitter just the crazy increases in rental properties. Like Dallas up 115% year over year in terms of rental listings. And so it's not just inventory that's increasing for sale. It's these rentals as your long-term rental operators or your short-term rental operators are trying to transition to long-term rental and they're not able to. So yeah, they're crazy. They're still swinging the hammers, Michael.
Where can people find you, Melody?
You can find me at M3_Melody, MELODY, M3 Melody Substack, and M3 Melody YouTube.
Jack?
Nobody Special Finance on YouTube. Do a live stream every morning at 9 a.m. Eastern Time. Market news, and then the occasional investigative report, a la the CoreWeave subject we were talking about earlier. And I'm also JG_Nuke on X as well.
And where can people financially contribute to what you guys are doing, Melody?
Substack would be awesome. Yeah.
Become a paid subscriber?
Yes, please.
Jack?
I have paid options. I have paid options on my YouTube channel, and I also have a Patreon account, but best way to contribute is just to watch the show and spread the word.
Right. Same.
I want to thank both of you guys, and I also want to encourage people to contribute to what they're both doing. This is very important work, and being independent and being able to continue to bring updates, there is a cost associated with it. So if you have the financial means to donate, I'd encourage you to do to both of these people. So,
Mike, thank you so much for doing this for us. Your name was the first one when we wanted to do a little "I told you so" show together. And so, you the work you're doing out there is just absolutely amazing. And I am just, so impressed by what you've been pulling off, the amount of interviews you're doing, all of it, the people you're interviewing. I mean, it's incredible. So thank you for having us and hosting us.
Anytime. And thank you for, choosing me to do this. And I look forward to the next conversation.
Thank you, Mike. Always a pleasure. Melody, you as well.
Thank you.
Mic drop.